More on the fixed income space. I'm pleased to say hello to Mark Todd, who joins us from Fixed Securities. Happy New Year, Mark, because I haven't spoken to you yet.
Happy New Year.
But it wasn't all good news either out of Fitch, because Fitch was also warning of a very good chance of Italy being downgraded. Does Italy really hold the key to what happens in the Eurozone, do you think?
No, I think so. I mean, it's such a large economy, and I think a lot of people are. They would be looking at the Italians to see how they're going to respond to the pressure, if you like. The constant re-rating by the ratings agencies just adds to that pressure, and if they can show some confidence around their fiscal capabilities and their ability to grow their economy, then everyone's stabilised and everyone's calm. I think the markets are looking for some calmness, but again, it's around how the Italians have responded. You know, they've got a bureaucrat in charge now, so they expect to see it a bit more stabilised than the Berlusconi experience. That would lead people to expect that there'll be some stability around how the government responds, and so Italy becomes the key, sixth biggest economy out there.
It's funny when we talk about some kind of calming of the situation, because certainly equity markets, in the face of no bad news, they can rally, but you still see the caution in bond markets, don't you? You can't have kind of equities rallying and all things clear when you've still got, say, the 10-year US Treasury below 2%. That doesn't suggest that everyone's, fine about what's about to happen.
I have a sense that when you talk to the equity people, that the Christmas has come late. You know, the market started to rally and there's some relief. And, I wouldn't want to take an awful lot of comfort in that relief. I think the market continues to be very jittery, and I think if you see cash rates under 2%, as you mentioned, in the States, there's real issues around the States and how it'll perform over time. So it would suggest that the equity market will be stable at best. I don't see a huge growth in any equity piece at the moment.
So what are your expectations for the year for bonds then?
The driver in the bonds will be. I think it seems to be that the market will be looking at the US environment. So it'll be the political environment and the Fed's behaviour. The Fed's tried to, as you say, push rates very low. The US mortgage rate at the moment for 30 years is around about 4%, 4.2, and it's the way the Fed's trying to generate some savings and some spending in those long-durated mortgages. So that would lead us to believe that they're very keen to see how that retail market in the States performs, and within that environment you see some pretty tough political battles taking place between the Republicans and then later on the Democrats. It's a very big year, both economically and politically. It'll drive the States, and it'll probably put a little bit of that calming effect we spoke about in Europe if they take centre stage.
So what's the strategy, even within fixed income investments? It's very hard to find safe havens, and we've seen that even just this week with the German auction showing that people are happy to just even, the negative yield. People are happy to give the money to the government or lend it to the government and say, actually, don't even pay us for that. So where do you find those safe havens? What is the strategy?
Brooke, we saw that in 2007, 2008 in the States, where it was, we were working over in the States, and the prices people would pay for cash was extraordinary. And so I would suggest that the safe havens that you speak of are, localised. So we would have, today we were doing some Praeco, that's a defence housing building. People are getting it's a 2020 duration, people are getting 7.2% return. That's where a lot of people are looking to put their money in fixed income assets and some high yielding FRNs. The Genworth, it's plus 400. You're seeing some of the regional banks are showing around plus 400 for some of their floating rate paper. It would lead us to believe, and the reaction from our customers are, anything between that 6 and 7% yield, between that 3 to 400% spread over the BBSW rate, they're safe havens as far as our investors are concerned, and I think that's going to continue on. You'll probably see, we expect to see a little bit of a movement back in some of the governments. So we expect to see some sell-off as people look to find, you mentioned risk on. They look to take on some of the semis, and they look to take on some of the high-yielding corporates over time.
Are you sensing any kind of feel that people take a shorter-term strategy, as in, we were talking with Craig James about equities earlier in the week, so you can't kind of talk about 1 or 2 days in the market. You look at the week and you notice that people even will take profits after 3 or 4 days. They kind of don't even want to look too far down the track. Are you sensing any of that with your clients?
I think you would suggest that it's the new clients that are coming in. You think of it in terms of the established clients. They're looking to trade some of that credit. They'll be taking some views on the Swiss Re Tier 1 paper and looking to see a rally in that. The majority of the customers that are coming from the equity space, saying that we can't take the volatility and we don't want to trade. We're an ageing population. They're looking for consistency in revenue, so they're looking to buy, 4 and 5 and 6 year assets that they don't really have to trade. They like to see the valuation, they like to see what they're buying and how that'll perform over time. But the days of moving away from, I'm going to buy BHP today, I'm going to sell it on Friday, and I'm looking to take a 2% clip on it. That movement, that market, I think, is now ended. I think that's structurally moved on. The people that are left, I would make the point, the people that are left are those who want to trade. But if the majority of the self-managed super funds haven't moved out, they are looking to move out. It's just a function of price. So the traders will be the ones that are left, and so you'll see volatility based on that trade.
Mark, thank you so much. That's a great outlook for 2012 for us. I look forward to chatting with you soon.
Take care, Brooke.
Thanks.
Bye.
Mark Todd from Fix.